On March 18th, 2024, the Bank for International Settlements, the central bank of central banks, quietly released a report that should have shattered every financial newsfeed on the planet. It didn't. The global silver derivatives market has ballooned to over $43 billion in notional value. But here's what they buried in footnote 7. The physical silver backing those contracts? 1.2 billion ounces available for delivery. Do the math. That's a paper to physical ratio of approximately 143 to 1. 143 claims on every single ounce of actual metal. The largest silver ETF in the world, SLV, holds roughly 475 million ounces. JP Morgan Chase? Yes, that JP Morgan was fined $920 million in 2020 for spoofing the precious metals market over 8 years. The CFTC called it a massive multi-year scheme to manipulate the most heavily traded precious metals futures contracts. And yet, nothing changed. The commercial short position on silver futures hit a record 67,000 contracts in January 2024. That's 335 million ounces of silver that banks are betting against. Silver they don't have in a market that's already running on fumes. Nobody's listening, but the fractures are widening. The physical shortage is real, the industrial demand is accelerating, and the paper fortress built over 5 decades is about to meet the immovable object of mathematics. This is the breaking point. To understand what's happening in silver, you need to understand the pattern, the same 4-stage cycle that has destroyed every monetary system in recorded history. Sound money. For over 4,000 years, silver was money. It circulated as currency in ancient Lydia, Rome, China, medieval Europe, and the early American Republic. The U.S. Coinage Act of 1792 defined the dollar as 371.25 grains of pure silver. Silver dimes, quarters, and half dollars were 90% pure metal until 1964. Why? Because silver is finite. It cannot be printed. It is the ultimate check on government spending and monetary debasement, expansion, and debt. In 1965, the U.S. removed silver from its coinage. Why? Because the government was spending beyond its means to fund the Vietnam War and Lyndon Johnson's Great Society programs. They needed inflation. They needed to print, and silver stood in the way. By 1971, Nixon closed the gold window, severing the last tie between the dollar and precious metals. The floodgates opened. Debt exploded. The money supply went parabolic. And silver? It became a commodity, something to be traded, leveraged, and financialized. The COMEX futures market launched in 1974, and within a decade, the paper market dwarfed the physical. Banks could now create infinite synthetic supply with the stroke of a keyboard. Loss of control. Here's where it gets dangerous. In 1980, the Hunt brothers tried to corner the physical silver market. They accumulated over 100 million ounces. The price spiked to $49 per ounce. The establishment panicked. The COMEX changed the rules mid-game, restricting buying, allowing only liquidation. The Hunts were destroyed. Silver collapsed. The message was clear. You cannot challenge the paper system. But the system didn't stop there. For the next 40 years, central banks and bullion banks used derivatives, high-frequency trading, and coordinated interventions to suppress silver prices. Why? Because silver is the poor man's gold. If silver breaks free, it signals that the entire fiat experiment is unraveling. And now, the control is slipping. Solar panel production requires 130 million ounces of silver annually and growing at 15% per year. Electric vehicles use up to 1.5 ounces per car. 5G infrastructure, medical devices, water purification, every major technology of the future is silver intensive. Global mine production, roughly 830 million ounces per year, and it's declining. Most silver is a byproduct of copper, lead, and zinc mining. As those industries slow, so does silver supply. The deficit is structural. The industrial users are now competing with investors. And the paper market? It's a time bomb with a lit fuse. Controlled demolition. We are entering stage 4. This is where the authorities attempt to manage the collapse without admitting the system has failed. Watch for these signals. Exchanges changing margin requirements and trading rules to prevent short squeezes. Mainstream media blackouts on physical shortages despite clear evidence. Central banks and sovereign wealth funds quietly accumulating physical metal. Sudden investigations into manipulation after the public loses confidence. The trap is already set. And when it springs, it won't be a market event. It will be a recognition event, a mass awakening that the paper promises are worthless, and the physical metal is the only asset that cannot be printed, hacked, or defaulted on. You've seen this before. Ancient Rome debased its silver denarius for over 200 years. In 64 AD, under Nero, the denarius was 95% silver. By 270 AD, it contained less than 5%. The empire was funding endless wars, extravagant building projects, and a bloated bureaucracy. They couldn't tax enough, so they inflated. Merchants stopped accepting Roman coinage. Soldiers demanded payment in real silver or gold. The economy fragmented into barter. The legions, unpaid and demoralized, allowed the borders to collapse. Rome didn't fall to barbarians. It fell to monetary collapse. The barbarians just walked through the ruins. Fast forward to Weimar Germany, 1923. The Reichsbank printed money to pay war reparations and fund government deficits. Hyperinflation consumed the middle class. A loaf of bread cost 200 billion marks. People burned currency for heat because it was cheaper than buying firewood. But here's the part they don't tell you. Before the collapse, the Reichsbank used propaganda, price controls, and central planning to convince the public that everything was fine. Journalists who questioned the policy were censored, savers were wiped out, and those who held physical assets, land, gold, silver, survived. The British Empire, same pattern. In 1914, the pound sterling was backed by gold, and Britain controlled global finance. 2 world wars, endless deficits, and a refusal to live within their means later. By 1971, Britain had to beg the IMF for a bailout. The empire was gone. The currency was trash, and the wealth had transferred to those who understood the cycle. Silver was the first domino in every case. When the people lose faith in the paper, they return to what is real. Let's bring this to the present and expose the numbers they don't want you to calculate. Receipt number 1. The shortage is already here. The Silver Institute's 2024 World Silver Survey projects a 215 million ounce deficit between supply and demand. That's the 6th consecutive year of deficits. Above ground inventories, approximately 2.5 billion ounces. But over 80% of that is in jewelry, silverware, and irretrievable industrial applications. The investable silver available? Less than 500 million ounces globally. Receipt number 2. Industrial demand is irreversible. Solar panel installations are projected to consume over 200 million ounces per year by 2027. That alone eats nearly 25% of annual mine supply. Automotive demand is surging. Electric vehicles require 10x the silver of traditional cars. The International Energy Agency projects 350 million EVs on the road by 2030. Even conservative estimates put automotive silver demand at 90 million ounces annually within 5 years. Add in electronics, medical applications, and water purification, and you're looking at industrial demand exceeding 650 million ounces per year and climbing. Mine supply? Stagnant or declining. There's no cavalry coming. Receipt number 3. The paper Ponzi. The COMEX claims to have 340 million ounces of silver in registered vaults, metal available for delivery. Sounds like a lot until you realize that the open interest, the number of contracts that could demand delivery, represents over 900 million ounces. You do that math. If even 40% of contract holders demand physical delivery, the system collapses. In March 2021, retail investors on Reddit noticed this. The Alquarazing silver squeeze movement drove physical premiums to $8.10 over spot. Mints ran out of inventory. Dealers shut down websites. For 3 weeks, the system teetered. Then, coordinated margin hikes. Media hit pieces calling it a pump and dump, and a flood of paper contracts to suppress the price. The squeeze didn't fail. It was postponed. Receipt number 4. The big banks are positioned. Here's the smoking gun. JP Morgan has accumulated an estimated 1 billion ounces of physical silver since 2011. They were fined for spoofing, but they never stopped accumulating. Why would the same bank that manipulates silver down in the paper market be hoarding the physical metal? Because they know. They understand the cycle. They're on the other side of the trade now, waiting for the paper system to implode so they can own the wreckage. Receipt number 5. The Federal Reserve's admission. In a March 2024 internal memo leaked to Bloomberg, the Fed acknowledged that persistent shortages in critical industrial metals, including silver, pose systemic risks to green energy transitions and supply chain stability. Translation: we know there's not enough. We know the market is broken, but we can't say it publicly because it would trigger a panic. The trap is set. Here's what they aren't telling you. The silver market isn't just a commodity story, it's a control story. If silver breaks free, if the price reflects actual scarcity instead of paper manipulation, it signals to the world that central banks have lost control of all asset prices. Gold, oil, real estate, bonds. Every manipulated market becomes suspect. That's why they fight so hard to keep silver suppressed. It's not about the metal, it's about the illusion of control. But illusions don't survive mathematics. And the math says this ends one way: a scramble for physical assets, a collapse in paper confidence, and a brutal repricing of reality. Nobody is listening, yet. But when the first major default occurs, when a bullion bank or a sovereign entity fails to deliver contracted ounces, the herd will move all at once. By then, the metal will be gone. The silver market is a microcosm of the entire financial system, over-leveraged, over-promised, and running on fumes. The breaking point isn't a prediction, it's a mathematical certainty. The only question is whether you'll recognize the pattern before the demolition is complete. This is the mechanism. We don't give you hopium. We give you the receipts. We show you the cycle. We expose the machine before it devours everything. If you want to understand what happens next, if you want to see the next stage of this unraveling, subscribe now. Because the second part of this pattern is already in motion. And when it breaks, there won't be time to catch up. Understand the machine, or become its fuel. Subscribe to the mechanism. The pattern doesn't lie. The system does.